Well, Laurentian Bank of Canada said profit rose in its most recent quarter. It also exceeded analyst estimates in that quarter, but it reported a drop in revenue versus the year before. The bank has been managing declining fees and commissions. It's also fairly far along the road now of a turnaround announced by its new leadership team back in 2023. We're joined now by Eric Provost, President and Chief Executive Officer of Laurentian Bank of Canada. Eric, thanks a lot for joining us. You say fairly early on in today's earnings release, that the focused approach on areas where Laurentian Bank can win and grab market share is starting to prove to be the right strategy. Let's just remind our viewers what the company's strategy is and what kind of progress you're seeing so far.
Yeah, thank you, Paul, for having me this morning. Effectively, we're starting to bear the fruits of the decision to focus our bank towards segments where we believe we have strong value proposition for our customers and that can deliver the right returns for us. And this is all about getting into even more specialized approach into commercial banking. And to come back to your initial comment in terms of revenue decrease, like the decisions we took last year aligned with our strategic plan aimed at exiting some of our platforms that weren't core to the focus we wanted to give this bank. An example of that is that we exited our full retail brokerage as well as our discount brokerage platform, and this accounted to the mix of revenue decrease, I would say, but very happy about the last quarter where we resumed growth into commercial banking book of business by 3.6%, and we see the shift in the mix of assets for the bank overall, again going towards commercial. That is fueling our net interest margin increase for the quarter.
The bank also saw loans rise in the quarter versus the prior quarter, so that's a month-on-month increase in loans. It looks fairly modest to me, about $300 million to $35.4 billion in loans outstanding, and deposits also increased, again, fairly modestly, I believe about $700 million to $23.8 billion. Talk to us about those increases, and are they affected as well by the exit from some business lines by Laurentian?
Well, again, we're matching our deposit growth aligned with our funding needs relating to our lending activities. I think that when you highlight that our overall book of business for the bank grew 1%, you're right. But I think that the most important to mention is that our commercial book of business grew by 3.6%, which means that in some areas, again, for us, aligned with the strategy, we reduce some lending activities in areas where we believe that the returns or the focus is not the right one, and we are maximizing our output in terms of our commercial specialty lendings, just like our inventory finance business, where we did highlight the new partnership that we came into agreement with Yanmar is a good example of our strategy bearing fruit in terms of fueling the potential growth for that subsidiary of ours.
You were asked several questions on the conference call earlier today, as CEOs are in every industry in Canada right now, about your bank's exposure to the tariff situation in the United States. And in the context of a bank, those questions tend to be: are you lending? Do you have borrowers who are in industries that could be hurt by a Canada-U.S. trade war? And the first question that was asked on that focused on the auto sector and the aluminum sector. So why don't you provide our viewers with an answer to that question?
So I'd like to reaffirm the fact that the bank is very well positioned, both in terms of capital and in terms of liquidity, to face macroeconomic uncertainties. And this is built into our overall models that is driving our provisioning in terms of potential loan losses. So we feel very good where we stand. We feel good about the portfolio as a whole. The big industry you just mentioned, like, are not for us direct exposure. But for sure, if we are to go into tariff war and counter-tariff, Canadian workers, Canadian consumers will be the first to be impacted. I also want to reinforce the fact that our bank, in terms of the retail piece, so the residential mortgage, is the bank that has the most insured portion of its portfolio. So we have a $16 billion mortgage portfolio that is insured at 60%, and the balance that's uninsured, we stand at a loan to value of 49%. So we feel very good about our position to sustain if we are a macroeconomic downturn coming from tariff wars.
So to return to where we began our conversation with, you are still the relatively early stages of leading a new strategy at this bank. Does the trade uncertainty make it more difficult for you to obtain your objectives? Will it slow down progress on your goals?
Well, I think we have strength into the momentum of executing the plan. I think also to remember, one of our great component in terms of our specialty into commercial banking is actually Northpoint Commercial Finance that is US-based, financing dealers for 90% of the book that are US also, and they distribute US products that are produced for the vast majority in the US. So we're confident that this platform will actually follow the trend of the US economy, which right now is in a good state and not the same concerns versus tariff we might be facing here in Canada. So we think that component will continue to be a contributor positively to our growth factors that are baked into the plan. And for the rest, it's building the foundational technology that will actually allow us to simplify this organization and be able to generate the efficiencies to help us achieve the financial goals we set ourselves for the medium and long term in the strategic plan.
Eric, thanks a lot for joining us today. We appreciate it. Eric Provost,